Hi everyone, welcome to the webinar. Apologies for starting a tiny bit late. We had some IT issues, but you're all in now. So delighted to see everybody here. Let me know you can see and hear me. And welcome to everyone, Piet, David, all of you from different parts of the world. I'm down here, by the way, in case you can't see me. I'm going to answer all your questions on this, and I've got a wonderful bunch of coconuts. I've got a wonderful bunch of slides for you, which are fascinating. So let me take you through them. Okay, first things first, this is not individual financial advice because I'm not speaking to you individually for a start. This is education for you. So please read that, what you see on screen right now. It is not a solicitation to go out and buy something or sell something or hold something, okay, because I'm telling you what I'm doing. I'm educating you and informing you, okay? First things I want to start on is using all my experience from my Bloomberg TV days, my work, continuing work with the Department for Business. Formerly I was the director of the United Nations Association in the UK and on the Council of Chatham House. So using all of that and worked in the US Congress. So using all of that sort of insights, information, education, all the rest of it. Just give you some broader overview on the markets, because some of you have previously said that actually you quite like that element. Hi, Ricky from Leeds as well. Fantastic. And Swansea down there. And so, look, the Ukraine situation is clearly not impacting the markets in any way whatsoever. All right. So that's the first thing. NATO spending is definitely increasing, and particularly German spending. For the first time since the Second World War, Germany has permanently stationed troops outside its own borders. Appropriately, diplomatically enough, they didn't do it in Poland. It was in, I think, Lithuania. But that spending is going up, and that obviously, public spending, what does that mean? Well, that fuels economic growth. Cyber threats are becoming a problem. I think they're a national security threat. If you look at what happened to Marks and Spencer's and the losses they suffered because of cyber attacks, if you can bring down a FTSE 100 company from trading through cyber attacks, that is of national economic and national security importance. And I don't think it's being seen as such, but cyber spending is increasing. We're seeing a lot of public spending in these areas in technology, obviously AI. TACO means people are not worried with the noise out of Donald Trump's mouth. TACO, for those of you who don't know, means Trump always chickens out. Trump always chickens out. So now it's got to the stage that he's got no credibility. It's a simple theory in game theory. It's the chickening out is actually a game in game theory, where we've taught this at economics. You're on a cliff and two cars, there's only enough room for one of them to pass a cliff. They're both going towards each other. What's your optimal strategy? And you can only go forwards and there's no brake. Your optimal strategy is to throw out the steering wheel so the other guy knows you're not moving. Trump can't do that. He keeps jumping off the cliff and chickening out, which means he's now noise. Anything he says, completely irrelevant. And contrary to what we thought, he can't actually crash the US economy, though he seems hell-bent on it, or the world economy for that matter, because the trick is look for profits. When I was doing my shows on Bloomberg TV during the dot-com bubble era, I'd always say, look for the profits. If the profits aren't there, then you've got trouble brewing, and the only thing that could be moving stock prices higher must be momentum, because it's clearly not profits. Okay, balance sheets can't move stock prices higher because balance sheets are fed by profits. Okay, and cash flow can only move companies higher for a short time because they act in the same way as momentum. If they don't feed into profits, then it's going to be short-lived. So at the moment, we've at least got profits. And that's good. That's earnings. Another word for profit is earnings. And of course, global growth is proving quite resilient as well. Now, that doesn't mean I am crazy bullish or crazy bearish for that matter. I'm actually, I could make you a case 50-50 either way, as you're going to see from what I'm about to show you on the charts. Okay. We've got another Swansea, Carwin and Paul over there. And really, in a situation like this, and I'm going to show you what I'm doing, what my wife and son are doing, but also in a situation like this, your best bet, actually it always is to work out what you can control, your investor profile. Now, if you're here, and I think that's, you got to be pretty risk loving and impatient to be here, then you would do this. Okay, and the dangers you face, I've written down here. Take a photo of this if you wish, right? Equally, if you're here, you can see what your dangers are. All right, it's very simple. I mean, it's all self-contained in here. Take a picture, feel free. Now, my wife and son, I've put into this category because I forced them in. They don't, I mean, he's 7, all right? So I've put him into that, and they bought into what I call the quality 5, and I'll get into that a little bit later. I would put myself closer to here. Why? Well, that's up to me. Everybody's risk appetite is different. What people wrongly think is if you're an expert, you must be here because you've got a crystal ball and can see the future. No, if you're an expert, you've actually got humility and know you can't see the future, and therefore you're rarely up here unless you've got a lot of certainty. Okay, so where does that bring us in terms of the S&P 500? Now, this measures short and medium term prices. So does this. This measures it on a weekly basis. This measures it on a monthly basis. Without getting too technical, pattern recognition, not guaranteed, obviously, but we are 50% there or we are 50% here. And I don't know which one it is. Now, some of you will say, oh, it's bloody obvious. Only retail clients are overconfident. Professionals are never overconfident. Okay, because we've had our teeth kicked out a few times by being overconfident. Now, you will all be able to say to me for certain, because retail clients do this. That's why Ladbrokes makes so much money. They will say, oh, no, we're definitely here. Or others will say, we're definitely something like this. So either we're going to do this, which is fall lower. You won't even be able to help yourself. You will want to tap that keyboard because it's an express an opinion. It's what retail clients do. They never have the wisdom of Buddha or of Warren Buffett to say, well, actually, we don't know, but if I've got quality companies, either way, I'll win, given long enough a duration. Okay, we're not in the crystal ball, what's going to happen in the next 5 minutes business. Therefore, now I could say to you, it probably looks like this. Okay, 70% probability at the moment, but 3 weeks ago I would have said 55%. 4 weeks ago, 8 weeks ago, I would have said, ooh, 60% like this. So what use is any of that? What it means is always pick the quality companies, and I'm going to come to that in a moment. So we don't know. My biggest worry about the market at the moment is sooner or later we do need to deflate a bit because it is overbought. That's what this means. When on a momentum basis, we're at the top part. Now, we're not just going to look at price charts. I'm going to look at valuations in a minute. We're going to look at profit and loss accounts, balance sheets, cash flow statements. All companies have 3 sets of accounts, P&L, balance sheet, cash flow. But at the moment, on pure momentum and prices alone, that does worry me somewhat. Doesn't mean we can't keep going higher. We can. Okay, technically, we can, right? We might even drop back down to here and then go up 1,000 points from where we are today within, I don't know, a year. Could happen. A lot of things could happen. Given that that's the case, I'd rather my wife and son were in the lifeboat and in the quality 5 companies and a few others, and I'd rather I'd had one foot out. Okay, that's the rational thing for me to do at the moment because I'm not completely confident to be all in. Equally, my job, contrary to what TikTok people think, is not to try and pick the bottoms. They're absolute idiots on very often on things like Twitter, because this is what the market does. It can either go down, sideways, or up. The numpties think your job is to try and pick the exact bottom. Why would you want to do that? Why would you want to try and do that when you know that it's statistically highly unlikely? Okay, so you'd be a fool. Even the biggest hedge funds, the biggest banks don't ever try and do that. Equally, why would you want to go in whilst things are still falling? Surely it's more rational to wait and be able to pick something up cheaper, right? You might buy a little bit, see how you feel, see if you get buyer's remorse, which you usually do. Most professionals and hedge funds get in at this stage. I don't mean professionals as in investment trusts. They're not professional. Okay, they're amateurs in suits. I'm talking about Winton Capital, AHL, the Buffett types. Get in once there's ample evidence. Why he never gets into an IPO, because there isn't enough data. Okay, so you want to wait till then. Doesn't mean we're gonna be right. We'll never be right. We will never, 100%. We are guaranteed never to be right, because the definition of right for those people is being able to pick the precise bottom. So given that they've defined it as that, okay, so they can sit there and go, ha ha, you didn't get the bottom. Insane. Okay, you can pick a loser as an individual in investing, because they're the ones who think your job is to pick absolute bottoms and they've still not understood it. That it's not, it's to make money. Okay, and safely make money for your risk appetite. So I would rather be getting in late, and it might be that I'm getting in, obviously I'm getting in later than my wife and son. Having said that, if this drops, I'll be the one who'll be okay. If it keeps rising, they'll be the ones who'll be okay. Great, hedge my bets, win-win either way. On that topic, some of the biggest investment lies that I want to clarify in this webinar before we go into some of the stocks that they own, what I like, what I don't like, why I would wait. And they are these. And the questions that you're putting up, I will answer these a little bit later on as we go through it, Raheem and so on. So feel free to put in the questions in there, but I'll answer them at the end, or you might just wait to the end and then ask them then so I don't miss it, okay? So here are some of the biggest lies that I've ever been told in investing. And oh, we've got a good number on today. We've got well over 100, so that's good. By the way, I'm going to put up some polls, not Polish people, but polls as in P-O-L-L-S. Should be able to see them on the screen. Now, first of all, numpties think you need to be right and can be right 90% of the time. Absolute nonsense. What you're trying to do is give a long enough duration. The shortest, we're talking about investing and not trading now. The shortest duration would be 12 months. If you're holding it a little bit longer, and you always want a quality company so the odds are in your favor, then you're more likely to be right. The other lie is, to put it in expert terms, is you need to be some kind of expert, and it takes rocket science. As Warren Buffett famously said, if you've got an IQ over 120 in asset management, everything above 120 is wasted. Okay, and it really is true. I really have to dumb down when it comes to investing. People like, from marketing literature, look, Warren Buffett said that, so even if you don't believe me, at least believe that man, and he's right. The marketing literature would like you to think, oh, he went here and he went there, he must be awfully clever, he can see in the future, he's far cleverer than me, and therefore let's create some kind of class system with investing. No, investing is like learning to drive. It is not like brain surgery where there might be some innate skill needed, or fighter jet flying. Okay, lie number 3, IFAs won't rip you off. Yes, of course they will. I'll tell you 2 ways in which they'll rip you off. First of all, they've got a conflict of interest, so they'll never ever tell you to hold cash, even if it's the right thing to do, like in 2022. They'll always try and sell you more things because they get paid fees. And they can't get paid fees if they're telling you do nothing for a year. Like in 2022, we had to tell people, look, I'm holding cash. Okay, so we got 0% that year. Let me say that again. We got 0%. So if you came here thinking I'm going to tell you I can see the future and I'm going to tell you you're going to make lots of money every single year, then you're in the wrong place. I'm just telling you what Warren Buffett also tells his people, which is, yeah, there was some years where we don't make money because the markets have got headwinds. What do you want me to do? I'm riding their coattails. I didn't invent those companies. If they don't make money, I can't make money. Okay, IFAs won't ever try stop selling you stuff, right? Because they've got to justify their fees. And people say, oh, but they don't get commissions now based upon what they sell you, etc., etc. If you don't think they get kickbacks in other ways, whether it's through fund manager lavish dinners and marketing operational cost contributions and all of those, you don't know my industry of finance and the city. Okay, another lie, fund managers outperform simple index tracking ETFs. No, they don't. Eugene Fama got a Nobel Prize in economics for that, and I've written about that for the last 25 years, from my Financial Times columns to every single one of my 18 books, and I keep repeating it. I keep showing the data, and nobody listens. Okay, so there we go. 5, you need to make millions to be happy. Well, guess what? When we look at the numbers, and I'm going to see if I can pull up some of the numbers for you, because I did a calculation based on pension retirement projections. In actual fact, yes, you'd probably need more than you think. So I created this thing. Sorry, look, 1 second. Let me see if I can convert that into a table. I wasn't planning to show this actually, but I think it's pretty good. There we go. Current age, retirement age. So assuming you start off with $500,000 at 50 and you want to retire at 60, and your growth rate is a mere 3%, 3 to 5 is what your IFA wealth manager wants to try and get you anyway. And let's say you eventually plan to withdraw 4%. That's how much you could withdraw at 60. If at 50 you had $500,000 and it was growing at 3% per annum until 60, and you plan to retire at 60, then you could withdraw 26,000 if your annual withdrawal rate is 4%, assuming you're going to live to, I think with this, the assumption was 90. okay? And we've put a whole, you might want to take a picture of this, we've put a whole load of numbers here. I can make this available, actually, I think. And this is pretty rubbish. What this shows you is, my God, even 7% growth rate doesn't help you. Let me see if I can put this in the, I can share it. I'll do it in the Q&A. I'll share I need to download and upload the file and stuff. Okay, so it just shows you for each age group. And what's worrying is just actually how little you can withdraw, because the shitty little growth rate. And you ask your IFA, what's your planned growth rate? 5. Now, let me just tell you, in 2022, the NASDAQ was up, what, 55%? In 2024, the S&P was up 20%. Anyway, they're not going to have years like that, because in 2022, they were down. So 2024, 2023, yes, they were exceptional years. 2021 was exceptional. But over a 7-year, well, actually, over the last 15 years, it's been averaging 15%. If you can't match that because your bloody IFA and fund managers are taking out the fees and underperforming the index, then you're left with that. And that's why you're ending up with 22,000 a year withdrawal, even though you'll end up with, you know, 500,000 or more. I mean, we used 500,000. Let's say you're going to end up with double, then you can double all these numbers, basically. But it was worrying, actually, when I look at the data, and anybody who knows me will know I'm very, very, very data driven, because I think it's just a better way of coming to conclusions rather than cognitive biases and stories and things we tell ourselves. So I'll share that before the end of the webinar. But it shows that growth is the most important thing, because first of all, you can't increase how long you want to work, presumably, unless you want to. Okay, you can't usually increase how much you can put into your pension, because guess what, you want to spend it elsewhere, and you can't just magically invent money, right? So growth is the main one. You can switch. Guess what your IFA and wealth manager want you to do? Can you save more, please, because they earn more fees? So don't tell me they don't get kickbacks from conflicts of interest with you. They get kickbacks from you by forcing you to save more, by giving you shitty growth rates. Giving you shitty growth rates is in their interest, because guess what? They don't get paid on performance fees. They get paid by assets under management. And more assets under management, guess how they can get more assets under management? By showing you shitty growth and saying, well, you're going to have to save a bit more, my friend. Oh, okay, got it. Another problem, news. Do not gamble before the news. That's not what we do. We are not here to work on narratives and stories. I know people love it. I know it's great on CNBC. And, you know, for 5 years, I had my show on Bloomberg TV, Tuesdays and Wednesdays. And yeah, I know, we love talking news. Don't do that in your bloody pension. It'd be the most stupidest thing to do. I'm not the only one who said that. Daniel Kahneman, who I used to write about in my FT column, got the Nobel Prize in Economics for showing why you shouldn't do that. So did Richard Thaler. Similarly, do not try to outsmart anyone. My job is not to try and outsmart either Goldman Sachs or anybody else. I am not on the opposite side of the table to all of these other people. I'm trying to ride their coattails. That's all. Okay, so I'm trying to find good quality companies, and if they do well, I do well. That is it. I am not trying to say I'm trying to be clever. Why would I be cleverer than anybody else? Okay, I'm going to put another poll up there. What I'm trying to do is just find simple, good quality companies. Then I too will live to 95, like Buffett, or longer, actually, in his case. So let me show you some other clever little things that you might not realize. We are not, and you should not think that I'm in the crystal ball business. As I keep repeating, I do not have a time machine, and that is not my job. The job of a journalist is to make out, or a fund manager or an IFA is to make out they've got crystal balls and they can see into the future because they're awfully clever. Now I'm telling you, I've got better qualifications than any fund manager you've ever put your money with. If you don't believe me, send me their names and I'll prove it. And I'm telling you now, it's bullshit if they're telling you that their degrees in economics or politics or law, and I've got all three of them, will help them become better fund managers. My secretary went from being my secretary after 2 years, for 2 years she was my secretary, went straight to Newton Investment Management as a fund manager. I can teach. My secretary, English literature graduate, part-time opera singer. Okay, no finance background. Anybody can get an fund management job. Doesn't mean they're good. Okay. Or neither do we have balls of steel. What do I mean by that? I'm going to show you drawdowns. I don't want volatility. I would rather have sat out the Trump up and downing, and I'd rather have been out and wishing I was in than gone through the volatility, because I showed you 2022, and I don't want to take a 20% hit, 30% hit in my portfolio, my pension. So I'd rather sit out and miss a 10% gain. Now, you might say, no, I'd rather be in all throughout all time. Well, then your life's even easier than mine, because you don't even have to make an exit decision. As long as you have quality companies, that's great. Okay, so don't have steel balls, don't have crystal balls, right? Just making that clear. I came up with this. Primed. Is your portfolio primed? All investing is about this. First of all, we want premium quality companies. What do I mean by that? Undervalued companies. Oh, that's weird. Nobody's voted on, will the Dow end up 2024? Or it's not coming up on mine. Hope that's all working okay on then. Okay, this is what I'm going to teach you in this webinar, and this is what a good quality portfolio, this is what actually making money is about with investing in your pension, your portfolio, or anything else. First of all, quality companies, and I'm going to show you the database a little bit later on. The way I work out, is it a quality company? As you will know, okay, is it premium? Is it undervalued? In other words, for the profits it's producing, the profits, why do profits matter? I know it sounds obvious. Why do they matter? Because humans care about money. Okay, somebody goes, well, you know, well, what makes you think that that's important then? Seriously. So for the profits they make, what am I paying per share? All right, profits per share. That's valuation. There's other ways to value things. Warren Buffett prefers looking at the balance sheet. I like looking at the P&L. Others like looking at the cash flow to work out valuations. How much cash is it generating is one way to work out valuation. Another is how much profits am I getting per share, unit share. Another way is to say, well, given all its assets, what if it burnt down? Okay, guess what? When you're buying a house, you look at valuation based on balance sheet. In other words, how much am I paying for the asset? When you're buying a rental property, you're looking at it on both cash flow and P&L, largely P&L. Okay, do you see the difference? There's different ways of valuing. When you say, well, what's the yield on it? You're really looking at cash flow and P&L. Balance sheet is when you're going to buy a home to live in. Do you see the slight differences? So we want that. We want it to be growing. None of these fit, by the way. None of these, so you can see how high my standards are. None of these meet our criteria. Some come close. We need all of these to be green. There's only one way to go through 10,000 companies which are eligible for my pension, my SIP, and my ISA. British companies, European companies, US companies, which are all eligible, and Chinese companies listed in the UK. In the US. Okay, there's Chinese companies in here. All of these I can put in my SIP or ISA, but the only way to go through it is this. That's the only way to look through 10,000 CVs. Okay, so I'll show you which ones I like, because first of all, I'm going to show you how many I don't like. 9,800. And I'm like Warren Buffett like that. I have a very, very high threshold for quality. You know why? Because it's my wife and son in that lifeboat. That's why. Retail clients are insane. They will throw their family under the bus when it comes to pensions investing or portfolio investing. They will roll the dice like they're in Vegas with no research, no due diligence, and they'll say, we'll just take a punt on that, shall we? See how it works out, because they've been led to believe, because it's never taught at schools, they've been led to believe it's all a gamble anyway. Well, guess what? There are people who actually have that attitude with marriage. You know, well, you never know. Just throw the dice, see what happens. That's how they have it with their investments as well. Okay, I want Croaky, which comes from Goldman Sachs Wealth Management. I stole it from them to be in the top 25% of all companies, because they generate 30% per annum as a group, as a portfolio on average. That's what Goldman Sachs research showed. Not guaranteed. Sometimes people get fixated. They almost have a heart attack. I'm sure we've lost a few people as a result of me revealing that. Okay, ideally, I want a bit of momentum, but I'm not, wedded to it. Sortino is really important. Comes from the hedge fund industry. And here's how you tell if your IFA is a Muppet. Ask them what they did in 2022. Did they tell you to hold cash? No, Muppet. Ask them if they know what the Sortino is. No, Muppet. Sortino is a hedge fund industry thing. It's like a consultant. Now, don't you want a consultant teaching you, or do you want a GP? Okay, IFA is GP. It's a multiple choice exam, by the way, with a 60% pass grade. So you can be wrong 40% and you can still be an IFA. And it's multiple choice. What is it? 4 questions. So you got a 25% chance of being right just randomly. If you do the maths with a 60% pass rate and a 25% probability of getting, so a quarter of the questions you're going to get right automatically anyway through random chance. and your pass mark 60%. Think about it. And that's who you're asking to advise you on wealth management. And then they're going to tell you, give it to St. James's Place and shove it into their overvalued, overpriced, guaranteed to fail funds. And why are they guaranteed to fail? Well, Eugene Fayman, Nobel Prize in Economics, Warren Buffett tells you the same. Guaranteed fund managers are going to fail. Why? Well, because they do something I'm telling you not to do. Don't pick from a narrow group of companies and saying, I'll only pick British ones. I'll only pick ones which meet a certain theme. You've got to start off with a massive database so you can filter down. If you can't filter down, it's like saying, I'm going to pick a World Cup winning team, but they're all going to come from Watford. Okay, it's just simple statistics. It's actually quite bloody simple logic. And you don't need an IQ of 120 even for that simple logic. Anyway, none of these at the moment would fit. Doesn't mean they're bad companies. Doesn't mean they'll fall. It just means there's better ones. That's all. It just means there's better ones. And it doesn't mean that the better ones will guaranteed do better than the ones which aren't worse, because Donald Trump might pick a really shitty one and tweet about it because he's got some vested interest in it. And guess what? We don't make as much, but the odds are in our favor if they tick all the boxes. What we're trying to do is not pick wonderful, amazing companies, actually. We're doing that by default. What we're trying to do is, first of all, not pick shitty ones. What we're trying to do is make sure we don't make any mistakes, stupid mistakes, like overvalued companies which aren't growing. Now, if you want to get overvalued companies which aren't growing, which have collapsed 90% because it appeals to some kind of crazy logic of yours or some kind of masochistic desire you have to destroy your pension, or some kind of self-sabotage from childhood trauma, be my guest. This is not what we're doing, though. Okay, if you want to relieve yourself over your pension and destroy your livelihood by trying to say, well, if it's dropped 90%, I'm sure it's bound to go up. You know what happens if a company's dropped 90%? You probably think highly unlikely to go down 95. If it's dropped 90, it's not likely to drop to 95. But actually, of course, it is, as you know. Do you know what the difference between 90 and 95% is? You might think it's 5%. It's not. It's 50%. Do the maths. And if you haven't done the maths and haven't worked that out, I'm worried for you if you're bottom fishing for companies. It's a 50% drop when something's dropped 90% to get to 95. It's not 5%. Like I said, do the maths and you'll be shocked. Okay, I wrote a column on that in the FT, and I got so much feedback because people couldn't do the simple maths, including mathematicians sometimes. Premium quality, research. We look at data, not narrative. If you're looking for journalistic data, and as Warren Buffett put it, breathless newsletters, the market's going to go, the market's going to fall, right? You're in the wrong place. It's great for social media and selling newsletters. It's shit for your pension. Forgive my profanities this evening. Insight. The insight I'm going to give you is this. You want to process, you want discipline. Why? Because then I'll control your mind and your emotion. You get a good night's sleep. Getting a good night's sleep is actually a very good way of getting a decent pension. Your brain is geared towards protecting you. And so getting a good night's sleep is actually a really good column in the, do I want to own this stock? Will I get a good night's sleep? By the way, Buffett does that if you think about it. I know I keep mentioning him. It's because I don't want you to trust me at all. I want you to cross-verify everything I say, either by somebody or something you know from the great man himself, or from the logic of what I'm going to be telling you. Don't trust me for anything. Why should you? Management, money, how much do we put? Generally about 20 stocks, equally weighted. Sometimes those weightings might differ, but at least 20. Might have up to 40. Beyond 40, pointless. If you're risk averse, you might hold more cash. You might hold some really low volatility exchange traded funds, and you might have some money in bonds, which I generally tend to do through either Flagstone or Wise, because they just automatically put it into a bond portfolio for me, and I don't want to be picking bonds because it's not my speciality. Okay, drawdowns. How much could it fall? I'll show you this in a second. You've got to know that. It's pretty easy, actually. Then expansion. Okay, what's expansion? Well, you might add to winners. You might have 2 times leverage exchange traded funds. Don't do that. That is for experts only. You might scale in to your positions, start small. That's just clever tactics and techniques to use. And of course, diversification, which really means we've got to make sure non-correlation. We don't want a bunch of correlated stocks. Contrary to what you think, cross-industry can be less correlated than within the same industry. Okay, what I mean by that is Microsoft and Apple can be less correlated to each other than Microsoft and Costco. Don't assume that just because things are in different industries that you've diversified all of a sudden. Diversification is not what you think. It's not what Grandpa taught you when in the 1960s industries were diversified. Finance was different to oil and gas. Nowadays, in a very connected world, things are more connected than you'd realize on the stock market. So when your IFA says, well, don't put all your eggs in one basket, you want a bit diversified, get a bit of Vietnam, get a bit of US. No, they're selling you more shit. That's not shown. Where's the cross correlation figures? And they'll just look at you blank and then run. Okay. Duration, 12 months minimum, because you've got to give it some time. You've got to give it some time. 3 to 5 years, even better. Okay, as long as they're quality companies. The longer you give it, if they're quality, easier your life is. Simple as that. Most of my students will minimum want 12 months. A lot of them are also comfortable with 3 to 5 years. And you want a process. Like I said, process, this is a process I give my students. Very simple process I give my students. Okay. Watch out, take a picture of this if you wish. Watch out for that bit. Don't do too much of this. Otherwise, you're going to be trading your investments, i.e. under 12 months, decide all of a sudden I'm risk averse and start selling. And if it does drop a lot beyond what you expected, then you shouldn't have bought it unless you are happy to hold it. Again, Warren Buffett test. If they turned the stock market off and you had to hold it for 5 years, would you be happy? That's how you know, is it quality? That's what forces you to make sure it's a quality company. And the other thing he often says, which is if you can't handle a stock dropping 50%, you've got no business being in the stock market. So unless it's one of those. Now, I've got students who say, no, we're going to go with the 12 months, 25% stop loss because they want to have that certainty. That's higher risk, a shorter time frame, smaller stop loss. It's higher risk than 3 years, hold the portfolio because they're quality companies. Obviously, self-definition. But they like the certainty of timeline and they like the certainty of the stops. Either way is fine. What's actually happened is we've done model portfolios based on holding period for at least 3 years. They've been proved more popular than the 12 months, 25%. So it just goes to show that actually given the choice, contrary to what I thought, people preferred the longer holding period and the no stop loss period within a portfolio. One of my mentors, I'm going to give you a copy of this book, Mind of a Trader, Lessons in Trading Strategy from the World's Leading Traders, is Bill Lipschutz. He was at Salomons when Warren Buffett was his chairman. You can download it for free from there. Okay, so I just want to let you know, reconnected poll lost. Apologies. That probably explains it. I think there is some, there's some IT stuff going on. So I've put the poll on. Let me just pause syncing on a few things as well, just making sure that I'm not using up lots of bandwidth. There we go. So the poll's up. Apologies, I thought it was a bit weird. So if you want to download it, then it's there. Okay, guys. Now, this is the process. I'm going to talk stocks in a minute. Don't worry, I'm going to use specific names. Everyone's always addicted to names. Actually, the process is more important than the names. So this webinar is slightly different to some of the others where I'm talking more about the process. You got all this news and data coming in. For me, I put it all into an Excel spreadsheet, as you've seen. Okay. And I'm just saying to you, if you're not doing it this way, you are gambling, right? But it's up to you. People like gambling. Process checklist, the data, and then essentially we're looking for, do we buy, hold, or sell, right? How do we, and the goal is this. The goal is, if I do half as well as I target and only get 20%, and by the way, in 2022 it was 0%, but thanks to market tailwinds, 2023 and 2024, you might say, well, but of course they were well over 20% because the market went up so much. Yeah, it wasn't me. As Warren Buffett said at his last investor conference meeting, Apple has made me more money for my company than I've ever made myself. Exactly. I don't make it. The market makes it for me. I don't make it. The market and the stocks and the companies invented by other people make it for me. Okay, whether it's a IBM or an Intel, I don't own those two, or a JP Morgan, Goldman Sachs, I do own those two. They make it for me. I don't make it. I'm not good enough. JP Morgan and Goldman Sachs are better than me at making money. I hope that's not some kind of crazy revelation. I just get a cut and ride their coattails, which seems a bloody rational thing to do. Okay, so that's what I'm trying to get to. And by the way, in case you're wondering why nobody ever bothers compounding, it's for this simple reason. the pain in the early years is so great compared to the contributions. You think, what's the bloody point? Plus, when you're young, who the hell wants to skip holidays and shove it all into savings and investments? Come on, live life. That's why people don't compound. It's all this crap about, oh yeah, you should compound. We should teach that. Yeah. Why don't they teach the psychology of trying to get people to do it? Because this is when the payoff is. Well, who the hell wants 2 donuts in 10 years if they can have their jam and donut today? You're going to take it today, aren't you? Because you're human. So we need to deal more with behavioral finance than just finance. Okay. So when my son in 10 years, when he's 17, getting go to university, and this is what his ISA looks like, and he's 7 years in, right? When he gets over here, 10 years from today, so let's say he's starting now there, when he gets in here, right, and he's making over 100 grand a year at the age of 18, I won't have a problem of him going, Daddy, can I have more money? No, you bloody well can't. In fact, can I have some, son? Now, what are we going to do? What are we going to do? Well, it comes down to this. When you get all of that shoved in, you've got 2 types of things that can happen. Either stocks go up or stocks go down. And there's only 2 types of stocks, what I call my quality stocks, which are the ones which just perennially deliver a lot of money, a lot of time. Okay. Whoops. Raheem, I'll come back to your question in just a second. Hopefully it's all working now, the poll. Sorry again, that I think there is some kind of technical issue. It's not at your end because I think it was at neither my end either. I think it's probably Webinar Jam end. Okay, so 2 types of quality ones are the ones which consistently year after year have significant gains. You know, they sort of average over the long term 50% per annum type. Rarely fall. If they fall, they have shallow falls, and those falls are quickly recovered. And this is because the company's P&L, balance sheets, cash flows are just their cash cows. They have high cash return on capital invested, high croquis. Okay. Now, these companies, by their very nature, have predictable falls. So, like even a Meta, which can fall 70% in 2022, the average price is what I showed you earlier, just gave a really big trigger early on that this is going to fall. Stay the hell out of it. Okay. So, rare, predictable falls. Usually shallow. If they're deep, they're very predictable through the average prices, and they have consistent year-on-year, very extreme highs. And now we've got to the stage after quite a bit of research of identifying, we've got about 47 of those we put in that category out of the entire world. Okay, so out of all the listed Chinese companies, which you can put in a sipp or ISA or 401k, wherever you are in the world listening to this, all the British companies, all the European ones, we've got about 47. There's actually more than that. We've just not finished interviewing all the rest, if you see what I mean, not finished researching all of those. The point is, with the quality companies, they're the type you'd want to buy more, and even if somebody said to you, do you want to hold forever, and you'd probably go yes. If they fall, they'd be the type, or if they rise, you'd want to do that. With performance companies, which are more, listen, they're doing well, numbers are good, the accounts are good, but hey, if you had to put your money, are these going to live for another 50 years? You'd probably say, oh, not so sure. Let's call something like a Palantir or a CrowdStrike in that kind of category. Now with these, you're probably going to say, hey, 12 months up, or, you know, am I up some crazy amount? In which case, if it drops X, sell Y. Then if they fall, the quality stocks are the type you'd probably want to buy more usually, unless it's what I call a daddy bet, right? Very simple. In fact, if you want to make your life easier, you just buy quality stocks and nothing else. So you might say, well, why do people have performance stocks? They love it. They just want to have more than just the quality ones. That's why we expanded the quality stock list, so it was all that they would ever need. Anyway, performance stocks, if they fall, then if either hits the stop loss or 12 months are up and you have to get out. So you can see why. You might say, well, wait a minute, hang on, son. Why don't I just get rid of those and hold for a longer period of time? Yeah, that works really well. Equally, I've got some who say, no, I just want the performance of 12 months. I really want to just nail it. Okay, so anyway, let's look at valuations, and then we're going to get into the traditional weekly update that I do. He says, oh my God, we're already 43 minutes through. I can't believe it. Microsoft, $30 you're paying for every future dollar of profit. Is that expensive? In historic terms, no. NVIDIA is certainly cheap in historic terms, and it's also cheap compared to other companies. You're paying $24 for every future dollar of profit, expected dollar of profit for NVIDIA. That is cheap. It was 19, and since when the price has recovered. So that is pretty cheap. That's cheap. This is ridiculously cheap. Okay, that's pretty cheap. But I'm going to show you, you know, what I own in a moment. Would I buy JP Morgan again? Well, I already hold it. It is cheap, but it's not a tech company. That's why it's cheaper. Some companies are undervalued. Now, valuation is not the only thing that moves stock prices, and we'll look at some of these a little bit later on. Growth projections do. Sometimes something's cheap because it's rubbish. Okay, that's why it's cheap. I'm trying to think of an example, because I was going to say Lidl or Poundland, but actually Lidl and Poundland are bloody brilliant. I don't know, something which is cheap because it's rubbish, actually. Right, earnings calendars. Dollar Tree, Broadcom, Lululemon. They're not going to move the markets. They're probably going to just reassure the markets when they produce good earnings and returns. But I was just showing this to say there's nothing market moving at the moment. What we've seen with these is these little bubbles are percolating upwards. That will percolate upwards. We know that. I'll guarantee that's going to percolate upwards. I just won't guarantee over what time frame. Okay, that's going to percolate upwards. Wife and son are into those big ones. I am not yet into those in any big way. I've covered by them being in it. If you think of me, my wife and son was one big portfolio, then at least they're in, I'm out. 1 foot in, 1 foot out is what I'm saying. And that's a more optimal strategy. If you think my strategy should be, well, why can't you see the future and pick the exact bottom? Then you're wrong. I'm not that guy. Okay. Past week looked like this. Interesting. These are still expensive. One day I'll buy these again, but not at the moment. Don't read too much into the past week because we're not here to trade. We're here to invest. Okay. Past year, that's where we are with all of these, which isn't bad. Over the past year, this has been making a bucket load of profits, which have gone into its balance sheet. So P&L goes into balance sheet at the end of the year. Okay. And it's generated lots of cash. The cash went from the cash flow statement to the P&L, and that's going to end up in the balance sheet. On a balance sheet valuation, that's got cheaper because guess what? The price hasn't gone up in the past year. Pretty much. Same thing with this. Pretty much same thing with this. Definitely same thing with this. Interesting. Not so much with this. Okay. And pretty much with this. They've got cheaper. Does that mean they're guaranteed to go up? No. Would I want to put my wife and son into it? They're already in it. Wife and son are already. Why aren't I already in it? Well, they're exposed. You've seen there's some reasons to think the market's overvalued and things would fall. So I'd rather just, I don't want to go in with both feet at the moment. Okay. And I continue holding the JP Morgan and the Goldman Sachs from previous. We'll go through some of these other ones as well. I am not a newsletter tip sheeter going, better buy Cisco because I think now we're going to have this, or get into IBM right now because of this. I mean, I might say I like them, but that'll be based upon the rationality of value, growth, income, cash flow statement. Now, if I were to click here, you'd see which of these 10,000 companies tick all the criteria. And guess what? I think there's about 50 at the moment which tick all the boxes. In fact, let me just do that off screen. How many are there? 94. That's it. Oh, sometimes people say to me, why do you talk about British companies? Okay, Wise is on that filter. Wise is on that filter. Okay, I'll tell you what else is. So there you go. Wise is on that filter. That's interesting because I like Wise actually. So anyway, interesting. I didn't know Wise was on it because I hadn't looked at it before this because we just had it all updated for our clients. Now, that's where we are with that. Year-to-date performance is where we are. Look at that. Unbelievable. And you might say, oh, no, but China, oh, but America's going to fail. America's about to blow up. That's fine. You don't have to look at American companies. I just gave you a UK one. We apply the same test to the UK. It's just that UK has far fewer companies. And if the bar's that higher, raised by the fact that there's a lot of entrants from the US trying to get into the portfolio, then guess what? The Brits get crowded out because they've only got 350 large companies for a start. And then you start getting into the small caps. Okay, and then into AIM and all the rest of it. So that's where we are. Now, price alone doesn't mean I'm going to go out and buy Uber. I still need to look at the data, not narrative. I mean, if I want to gamble and have fun, I'll go to Vegas and look at narratives for stocks as well. ETFs, for those of you who don't want to look at just, say, the US, there you go. There's some ETFs on emerging markets. Feel free, be my guest, go have a look at them. There's the Chinese ones, there's Asia Pacific. I'll look at INDA in a minute. I'm not buying it yet, but I wouldn't have a problem with it longer term. That's all I could say. I mean, I wouldn't buy it right now because I think still going a bit sideways. I think they're growing at 7.5%. People go, wow, that's amazing. They forget that they're targeting 10% growth per annum for themselves. out of there. And you've got other ones. I'll do a separate webinar on ETFs. Where are we year to date on the markets? UK is up there year to date. Unusual for the UK ever to be beating the US. It won't last because it never does. Over the past year, NASDAQ 16%. Okay. I'm going to reset that poll and I'm going to show you another one. Oh, before I get in on about that. Yeah, Rolls-Royce every single week. I'll tell you what I say. If it falls X, sell Y. Okay. Ride it. If it falls 5%, decide what Y is for you. 10%, 15%, 20%, 25%. Just decide what Y is for you based on your risk appetite. If you think I can see into the future, you're wrong. Now, if you've liked the stock so much, you might say, well, if it drops 50%, I'll sell 100% only then. Fine. But if you're very risk averse, you'll say if it drops 5%, I'll sell 25%. And then if it drops another 5, I'll sell another 25. You'll work those numbers out. That's a better way to avoid regret and more likely staying longer than saying, oh shit, what's the future hold? Because we don't know, right? It'll stop you getting out too soon. It'll avoid regret. It'll mean you sleep better, and it'll avoid you doing an all or nothing, which would be stupid. Exit, sort of saying, well, I've got to sell all of it or go buy it. No, there is no fill or kill order for retail clients. You don't have to buy or sell all of it. Okay, it's very simple. There's your Rolls-Royce strategy right there. There's your entire playbook, regardless of what happens in the future. That's your entire Rolls-Royce playbook. Simple. Okay, and I could do it with my eyes closed. Total earnings, 15%. In the US stock market, 13% market cap has risen. That's good. Revenues have only gone up. Sales have gone up 6% now. One of the reasons why I think sales have only gone up 6%, but profits have gone up double that, is I think AI is improving productivity, margins, and so on. Margin expansion is one key reason why that's happened. Another one is mass accountancy fraud, which I don't think is happening. Okay, so it's all very healthy. This is what, when I was doing Bloomberg TV, I'd look at and say to the viewers, I'd say, look, as long as earnings are rising faster than market cap, you're okay, and faster than revenues. When that wasn't happening with the dot-com boom, it was like, listen, guys, we're going to fall some stage off a cliff. Ride the bandwagon of momentum, but as soon as you see it falling off the cliff, get the hell off, like 2022, by looking at short and medium-term prices using the indicators that I showed earlier. Top gainers, okay. Wife and son own, no issues owning, wonderful. Wife and son own, wife and son own, wife and son own. I don't have any position of size to speak of at the moment. So half in, half out. All right. This is the UK. Not so good. So a bit worrying in terms of sales and profits and all the rest of it. I'll answer all those questions coming up, so don't worry, stick with it. Where are we on the the UK markets? And I'll do a separate webinar just focused on UK. I know Rolls-Royce has been doing incredibly well. You've doubled your money. P is only 29.7. Without having looked at all the financials on it, I would say I see no reason why it wouldn't continue, just as a sort of generic term. But I'd say my exit strategy, as I give my students, is if it drops X, sell Y. And guess what? That means that they're never wrong, because the definition of wrong would be taking on more risk than you wanted. And they're not doing that with that. Let me just get Rolls-Royce for you. Okay, Royce, R-O-Y-C-E. No, I'll have to find it later on the list. Right, well, ideally I want that going up a bit more like that rather than up here, because it could drop. So I might be able to pick it a bit cheaper. The worry is it'll go sideways for a bit. Longer term, it's going to do this, and that's fine. Really, the issue is the rate of growth. And remember, with exchange traded funds, the rates of growth aren't phenomenal necessarily. So if you look at this longer term, since 2019 to 2025, you've really only gone from about 36 to 53. You've not even doubled your money. Okay, over 5 years, you've not doubled your money. Now, over 5 years with equities, unlike exchange traded funds, you should be doubling your money, because that's just the 15% per annum which is what you need to double your money over 5 years, which is the S&P. So that's just the tailwind. That's background noise. That's background radiation. So you should be. ETFs tend not to be able to do it. They're just giving you less volatility and more stability. Okay, that's why you get ETFs. Lower volatility, more stability, lower growth, of course. But with an equity portfolio, you'd expect at least to do that. And if you ramp it up to 25%, average gain, let's say, because there's a tailwind, or you do better with an equity portfolio, then that would mean doubling it in 3 years. If you did double it in 3 years, count yourself lucky that you got a tailwind like 2023, 2024. And if you didn't, then that's the norm. A bit like houses in the 1980s in Britain. They used to double in 3 years if there was no recession, double in 5 if there was a recession. If you remember property, just look at property prices. Okay, that's what they used to do. No guarantee they'd continue doing it, or stocks. Apple, wife and son happily in. I think I'll just wait a little bit, because I think I might be able to either deploy my money elsewhere for a bit longer, because it might go sideways for a bit longer before inevitably going up. Okay, and if you want to argue that it's the end of Apple and it's shit and it's rubbish, then don't buy it. We don't need to have an argument over it. You know, it's not the Middle East crisis. We don't need to take a side, or Ukraine, Russia. You know, it's fine. Or Donald Trump and Democrats will just say, oh, okay, you don't agree with me, fine, don't buy it then. Buy. Okay, it's a lot, you know, nothing ever to get flustered about. It's only money. That's its statistical projections of its moves based on its historic moves. So it's a bit like a coin. You know, a coin will 50-50, you know it's going to go within a certain range. So if you take a stock which isn't guaranteed in the future to go in a certain fixed range like a coin, but if you assumed it were to, which is a big assumption, then these are the future projections. And you can see that over a 250-day period, statistically highly probable to get a positive return. However, why do people mess it up? You mess up your pension for 2 reasons: panic and boredom. What is panic? Panic is when there's a low probability of a big move in a short period of time, i.e. this gets hit. That's when you panic, okay? And so that's where you never get to the gains. All of those people who sold Apple before today, basically, ever, right? They panicked, or they got bored, which means 250 days went by and then you got a 2% return. So either way, when you're on this left-hand side, that's what causes you to F up your pension. Boredom or panic. Boredom or panic. They're the only 2 things which ever cause you to mess up your pension or portfolio investment. Why do I show all this data? It has a very calming, soothing effect upon my students, who then realize, oh, I don't need to panic, okay, or be bored, right? That's why. 46% of you said you're pissed off with your fund manager because of underperformance. It should be even higher. Lack of communication, that's pretty bad. I mean, if they're not giving you webinars once a week for at least 1 hour, then yeah, that's lack of communication. Fees, I agree. You shouldn't be paying any fees, basically. You should be getting free webinars like I give you. Not trustworthy, damn right. Lack of information, education. They don't want you to be educated, because if you're educated, you'll know how stupid they are. Lack of transparency. I mean, look, listen, seriously, anybody can become an IFA. So if I said to you anybody could become a doctor, you'd say, no, I'm not going to trust doctors. I don't know why they have the same problem with IFAs. Microsoft, wife and son in, overbought. This is the typical classic problem at the moment. It is overbought. In other words, it's a bit like this. Imagine it was here. You'd probably say to me, well, I can see why, Alpesh, you're being a bit cautious. Let's say it was here and we didn't know what the future held, okay? Right? You'd probably say, if I said to you it was a bit overbought, i.e. it was here. So imagine we go back in time to here, as I've been saying anyway. You might say, oh, I can see why you're a bit cautious. And you don't want to dive in. Well, I'm still feeling exactly the same here as I was here. And let's assume this exact same scenario is about to repeat itself here. Okay? Now, does that mean, why did you throw your wife and son into it? Well, because there's enough probability it won't, and that'll happen. Well, why don't you go into it? Because there's enough probability it will happen. Got it? I don't know the future, but I know it's a good quality company and I'll be okay going forward. Because over 250 days, I'll probably use it with 2 times leverage on the ETF to try and get closer to a 20 to 40% return. Okay, and this is pre-leverage, so I'll be fine. Novo Nordisk, wife and son, yes. Me, not yet, but oh boy, will I, yes, in due course. Now, if you're risk-loving and you want to dive in, be my guest at your own risk. Me, I'd rather wait. Did I call the bottom? No, of course I didn't. But do I like it for the long term? Yeah, and this is what I mean by the nature of a quality company. Okay, similarly with this, what I mean by the nature of a quality company is multiple years of significant gains. When the drops happen, they're predictable, as you can see here, and they're infrequent, and other drops are quite shallow and quickly recovered. Very few companies exhibit those characteristics. Those characteristics can be seen both statistically and visually, and they can also be seen in the P&L, balance sheet, and cash flow through this. Now, some of you are number autistic, and you'll see this, and you go, wow, I can see it on the numbers. Others are more visual, and you'll go, ooh, I get that. And some of you are mathematical, and you'll see it in this. I like to look at it in all three. Makes my life a lot easier. Okay, that's what Novo's looks like. Bit worrying, so be careful because it had this massive drop. Now imagine you get in when, as I say, things are overbought, and I say to you, there's a small probability it might continue, but most times when it's like that, it's going to fall. You might say, no, bullshit, I'm getting it 124. Well, you might end up with that. The idea with a quality 5 plus company, of which this is one, is either to buy more or to wait it out and hold it for a longer period as part of a portfolio, not as a single stock where all your money's in that and nothing else. And don't look at it as just one thing and nothing else. Okay, otherwise you would panic. Okay, why do I look not just at UK stocks but also at US stocks? For this reason, because that's the poverty gap. Your IFA is going to match at best, and they're not even going to match this. They're not going to match the index tracker of the UK. Over the last 10 years, the UK index tracker is up 50%, right? So your pension might be up 40% after fees and after crap underperformance, right? Go find out over the last 10 years. Ask your IFA, what's your typical fund client return over 10 years? And they'll go, yeah, 50%, all right? In the US, the typical index tracking fund, if it's tracking the NASDAQ, is up, well, they also underperform the index, so under 370%, but maybe 300%. Again, the Americans are pissed. They only, got 300%. So they quadrupled their money, and they're really pissed that they only quadrupled their money by getting a 371% return. They're really angry about that. They're like, what the frick? We only got quadrupled our money. Index tracker would have done better. Anyway, thanks to people like him. So I like to follow people like him. Former hedge fund manager at DE Shaw, would you believe? People don't realize that comes from the same industry as me. That's the Brits. The Brits are getting poorer and blaming it on government, blaming it on, I don't know, illegal immigrants, asylum seekers. God knows what they're blaming it on. Whatever they're blaming it on, they're not blaming it on fund managers, perversely. You know who I'd blame shitty pensions on? I wouldn't blame it on the chancellors. I wouldn't blame it on the tax rates. I wouldn't blame it on any of that. First people I'd do is not even the lawyers. Unlike Shakespeare, first thing I better not say it actually, because this goes on social media. I'd go after the fund managers. I think you all know the quote from William Shakespeare about lawyers. Right. Model portfolios. Now, my team of rocket scientists, they're not really rocket scientists. I like to think of myself as Elon Musk and a team of rocket scientists, but we're not. We want to create those kind of 21 rockets, okay? Well, 20 rockets. That's my dream rocket. That's mission to Mars. 30% annualized return, 10% volatility. I've not managed to create that yet. Okay. I've had a student who's got very close to that. The past is not a guarantee of the future. Sadly, I wish it was. The first person to wish it was is me, my friends. No webinar whatsoever. That too from one of the largest pension providers. Well, there you go, Jubin. I know. Can you believe it? I do one a week, free, because I love it. On an evening. You know what they're doing on an evening? Watching Netflix. Because they give a damn, don't they? Okay, so that's what I want to know. There is no guarantee of that. There is no implication in anything I'm saying of that. If I get that, I'm happy. Okay, so that's the rocket I want to create. Some of these rockets are crap and I don't want them. Okay, I'm just giving you the statistical options. So that's what we're going for. By the way, if you want to look at their portfolios, here they are. If you want to know what wife and son own, well, those by implication as well, because it's in there. Okay, I wouldn't buy that at the moment. That we're keeping a close eye on, as I said. This we're not really looking at. They're happy to, but not looking at it. Anything on here that catches my eye? We will one day look at that again. Okay. Now, why do we try and avoid daddy bears or years like 2022? because that's what we're after. That's what we're after. Okay? Now, the easiest way to get rich is by, I'm going to tell you in a second what this instrument is. I think I'm going to tell you. That's it. Imagine your portfolio looked like that. Could you handle it? And if you could avoid the daddy bear, which I've explained, I'll explain again, the falling short and medium-term prices, then you'd have even avoided most of that. Even if you avoided half of that, you're still making a lot. Would you be happy with that? I didn't do that. I didn't create that. I didn't invent that. I didn't invent that. I can't take credit for it. I didn't invent the company or the portfolio that made that. That's a simple index tracker. That's actually an exchange traded fund. Okay? What I want to do, and I can't guarantee it, is I want to start off with, okay, at the end of 3 years or at the end of 5 years, how much is a million, oh, sorry, at the end of 3 years, how much is a million likely to be and what are the probabilities? Now, it might only go up to 1.5. It might go up to 2 to 2.5. Might happen sooner if there's tailwinds, and it might happen might go more if there's tailwinds, and I might get less if there's headwinds and take longer. Those bits are out of my hands. I want to know my drawdowns just so I know how bumpy the road's going to be. And the maximum drawdown in the pension might be 15%, but if I'm expecting it and know it could happen, I'm less likely to panic. I'm not going to panic anyway, and I also know there is a slim possibility it could be deeper, but I know if I've got quality companies, it should be fine. I also know if I run the numbers on the portfolio, then I want to know what's the probability that 50% of the time I'm going to get more than double the money and below. So this kind of data, this is just for illustrative purposes, okay? And I want to break it down year by year. For each stock, I want to know, okay, what are the returns? Now, I don't know in a given year whether one stock's going to do that, isn't that bloody amazing, or the same bloody company 2 years earlier did that, okay? I wish every year, every stock went up. Doesn't happen. Some of them go down month after month after month. I want to talk broader problems. This is how most people pick stocks, as you know if you watch me. The reason I say you want 20 to 40 is because after 40 you've got too many. And the problem is your IFA will send you funds, and those funds will have about 100 stocks in them, which is a complete waste of time other than for the fund manager and the broker that he uses to buy those funds through. Buy those stocks through. Utterly useless. Statistically, mathematically, academically, all proven, utterly useless for fund managers to have more than 40 stocks, okay? Which is why Warren Buffett has so few. Most of his money is in his top 5 holdings. 50% of his capital is in the first 5 holdings, okay? So, and less than 20, you've got a bit too much risk. And you can't remove market risk unless you're out of the market, i.e. 2022, right? So there's another problem. Now, I'm going to start answering some questions in a second. Okay, sorry, I've gone on and on quite a bit. This is the other problem. Don't know when to let go. So either it's going to be you're going to hold for 3 years, not forever, because Warren Buffett says that, but he doesn't actually ever hold anything forever. Okay. Well, I guess Coca-Cola. And this is the other thing. Don't look at that. Don't be drinking that when you're investing. Don't be reading that. Don't be reading the magazines, and don't be trying to find it on the internet. It's got to be calm, cool, collected, longer period. And the ways we do it through the data. But I love this. I love this from Goldman Sachs. It has been the holy grail for me. It has been a secret cheat. Of course it is. Some bloody their quantum database, Goldman Research. So I had a lunch with them, God, 20 odd years ago, and it changed my life because they presented me with, amongst other things, well, not just me, about 20 of us in a room, 30% CAGR for companies in the top quartile. Okay. In other words, cash cows, companies which produce the most cash on the capital. Now, if you think about it, it's like literally buying a cow which produces cash. That's what a cash cow is. Okay. And they do a lot better than companies at the bottom. And this is all their research team ever does. They think of new ways in which to make money. And I didn't know this. This is what they all spend their time doing. And of course, it makes sense. Yeah, by the way, if you've got 50 million, they'll take you on as a client. All right. Now, I think there's 2 simple options for private investors, their pensions and retirement and all the rest of it. Option 1, pick your own from an approved list, which is what I do. Okay. Valuation, growth, cash flow, low volatility, high consistent returns. Okay. That's like the ingredients in a cookery. game with the recipe. Option 2, have somebody make the cake for you, which is the other option, model portfolios, and we're doing these more for clients now. High returns, historic, does not guaranteed in the future. Higher drawdowns to lower drawdowns and so on. And number 3 is mix and match. So let's have a look at some of what I'm talking about. Either you're going to do it through this, but please, 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 for God's sake, go through, have a big pool of CVs. Every single fund that exists there, with the exception of Warren Buffett's, picks from a narrow gene pool. They will either be UK companies or tech companies or AI companies or Dutch companies or Chinese companies or whatever. They've got one hand tied behind their backs. Okay. My job is to try and find these. I didn't even buy this one. Ravi did. And we gave him little medals. We give medals to students. We've got to start doing this again, who get over 100% in 12 months. Now, 100% in 12 months is not only not guaranteed, but it's probably because there was a tailwind, and it did. Because if I knew it was going to do 100%, I would have gone to Ladbrokes and got 10,000 to 1 odds. I would have bought it myself. I didn't buy it because I can't buy everything. It was on our filtered list. He picked it. It did rather well. And after 12 months, sold it. Okay, he did well that year with Crocs, with Etsy, Medifast, and crude oil. 2024, how did this approach do? Well, the market did well. I didn't make the money. These were the big ones that made the money for us. But the market had a massive tailwind, a lot of stocks that went up. The market did it for us. Okay, 2022, we got 0%. 2023, not to be ever repeated again, I expect. It was the market which did 80% for us out of the picks that we had. Okay, these weren't the only picks, there were others, but these are the ones. Sorry, I'm not showing all the picks. I'm showing some of the picks, but overall, all the picks generated 80% in total, if you see what I mean. Because you might look at this and go, hang on, that's over 80% if you take those. Yes, but there were some which did less than 80, and that's why the number comes to 80. That will never happen again. Just assume it will never happen again. And the past is no guarantee of the future. Did we get lucky? Well, yeah, the world got lucky of 2023. Will it happen again? No, just assume it won't. I'd rather you assumed it won't, because if I could get 80% a year, I'd be bloody happy. Because in 2022, we got 0%. Just so you know. How did we know to go into cash? This happened. That's it. Very simple. Not narrative, not trying to predict the future, not trying to use my master's degree in politics and economics and shoving a bit of philosophy in there and a degree in bloody law as well. Utterly useless. All of those useless for this. It was this. That's what was useful. Although I did discover this when I was at university, because when I finished the degree, I spent the summer reading at the Bodleian, and one of the books that I read I came across this, and then that was it. I was addicted. 1995, summer of June or May, whenever the exams finished. I think they finished in May. It's been that bloody long. Oh my God, 30 years ago. And that was it. And I've written about it in the books and still use it when I'm on TV. That's all I did. Nothing, it's not guaranteed to work, but it was good enough. Good enough will get you enough. Option 2, model portfolios. In other words, this. You want a portfolio which enough data, at least one bear market, preferably 10 years of data, but at least one bear market. And these are the numbers. What's the average annualized return over that period? What's the risk? More importantly, what's the drawdown? Not guaranteed to repeat itself, but you need at least one bear market within there, like 2022, incorporated in, and you work on the assumption you didn't get out of that bear market. You took that hit, you took that whack, and you were underwater and you had the drawdown. So in other words, you take your portfolio and you put it through a crisis situation. You stress test it of a shitty market like 2022, and you say, assume I didn't get out. What does it look like? Even if I go through the crap, does it still give me great returns? And for me, that's fine. Okay. That's the closest we've got to our rocket, which is closest to 30% we've got to. Certainly hit the drawdown of under 10%, but we couldn't quite get it to 30. No guarantee of the future. I wish it was guaranteed in the future, because then wouldn't that be wonderful? It just, all you've got to do is you just got to wait and hold on to it. Okay. That's where it is. I've got questions. Which book? I'm going to give you the book now. I'll put it in the files. There you go. Investing Unplugged. I've got 18 books. They're all on Amazon, but there's one you can download straight away. I've put it on the sharing. You can also go here. Whoops. Go here for the books. There you go. The books are there. Of the 18, there's a few. I'm not going to go into how they destroy your money, because I think most of you know how fund managers, through their fees and everything else, destroy your money. And don't fall for this crap. That is a marketing gimmick, and I can't believe they do it, because despite all of that, they do that shit return. Okay? Your job, my job, everyone's job is this bit, is to get to this. Unfortunately, to get to that and get you've got to go through those years. See, the return's the same, which is 5% more than the index tracker. That's all, just 5% more. Let's say you only did the index tracker, fine. But the return's the same each year, but it only gets exponential up here. Why don't people do that? Why don't people do that? Very simple, because for the first 7 years, they have to sacrifice a lot in order to get their jam later here. Okay? Buffett's at this end. He goes vertical because he's been doing it long enough. I'm getting closer and closer to vertical as I get older. The irony of it. Youth is wasted on the young, as they say. Okay, that's what we're getting. No, has it gone? 21. That's the one we want. That's the dream. I haven't got there yet. I haven't created that yet. Still trying to create that rocket. I've told you about that. Forget that. You're going to be one of these characteristics. Most of my students are this, mixed user. I've got 1 or 2, literally 1%, which are the warrior. Okay, let me ask more. I've shown you that. Watch out for these people. Honestly, I want to take their business off them. I want them all going on to what I do, because I think every single one of their clients can do it themselves. And I think they have a business which shouldn't exist for that reason, let alone the fact that they underperform simple index trackers, but they still exist. Can you believe it? Retail clients, right? Lots of ways to value growth. These are the things you need to look at. Like I said, just as a summary, or I put it this way. So now you know the depth of what it takes to make it. My first column in the Financial Times, 9/11, 1999, on why I'm selling UK holdings and buying US. More choice. It wasn't because I foresaw anything. More choice. More choice meant I'm more likely to make money. It was simple as that. I still remember that. Picking it up, my first column, going to the newsagents, picking up the newspaper, seeing name and photo in print. And yeah, I did cry. There you go. That was 2024. Won't happen again. Always assume the upside won't happen again. Always assume the downside will happen again. It's as simple as that. Now, here's another thing. Don't get greedy. That's the long-term average, long-term as in the last 15 years, of simple S&P index tracker. The UK isn't. It's shit. The FTSE All Share is like 1% per annum over the last 30 years or something. It's pretty crap. So that, but look at what you'd have to do to get 20. You're only saving 1.2 years. You might as well to double money. You might as well you double it a bit sooner. You might say, it's not worth it, Alpesh. I'll go for the quiet life and I don't need to double it every 3.8 years. I'll double it in 5. Now, why would I go and do that? Well, because I'm secure. I've got enough. If I do it, so it's not play money, but whatever I've got secured in a vault somewhere, that's safe. It's a bit like that game show. That money's safe. That's locked up. That's all right. Now we're just going to play with this. What do you want to do? It's like that. And obviously with that extra money, I do want to try and do it in 3 years. Why? Because I'm testing my skills to see if I can create the rockets and the portfolios. But I know the odds are in my favor. Average positive return, 32% over a rolling 2-year period on the S&P. So it's the old saying, and again, Warren Buffett, it comes from, the man's a bloody genius. How do you beat, oh God, who's a great tennis player? How do you beat John McEnroe? Okay, somebody, he said, look, it's really simple. You play him at any game except tennis, right? Similar thing for me. How do I do well? Well, I'll pick from here and I'm going to win. I'm not going to bloody pick from the Vietnamese stock exchange or the Chinese just because everybody writes nice little stories to sell their magazines and they're paid by the dollar per word. Don't be daft. We're doing okay. We're doing all right. Okay. If you want to see more reviews, video reviews, there they are. Right. Don't worry about that bit. Beware of these people as well. They've effed up massively already. They've destroyed so many pensions. 50% loss. There you go. Because why? 2022. They can't go into cash because they won't earn money if they go into cash. And they'd rather sell your pension down the toilet than not earn their fees. Simple as that. They won't ever tell you. As you know, I have a program. If you want all this done for you, then we do it. My aim is to float the company. I'm at the London Stock Exchange next week. And I've already spoken to them. I want to get venture capital in and then float the company and challenge St. James's Place. Because I think everybody can, with the data, can do this themselves. And here's the beauty. You put it with your own broker. You have access for life. You don't pay any fees onwards. There's no running subscription costs or anything else. And people go, what? Wait a minute, we've got it for life and we're going to get the data? Yeah. We've got access to you for life? Yeah. And if I die and fall under a bus, we've got a team, so don't worry. And all the videos and everything I teach you is already recorded, so there's no danger of that. But that's why I created it, because I want to get a whole bunch of people to prove to venture capitalists this works, and to prove at a hopefully a 30 or 40 million valuation, get some investors in, and then float the company. We've already got global clients. But that's the idea behind it, and I want to remove St. James's Place. And if I say it often enough, it's going to happen. It's as simple as that, and it's first come, first serve. So if you want us to do it for you, it's there. If not, hey, you get lots and lots of free education in any event. Now, Alpesh, are you in Google? It's ridiculously cheap. It is ridiculously cheap. I said my wife and son are in. Thank you very much. Love your quote about the youth being wasted on the. It's not my quote. Somebody else famously said it. Somebody else said it. Another great, really good one this week. Grateful one. Thanks. Oh, thanks, Roger. Oh, excellent. I'm not sure what I did, which was so different, but yeah, I'll try and mix it up a bit more. No, yeah, I know, Tubin. They don't bother, do they? Profits up, outbound product pricing reacting faster. Paul, input prices, inflation flowing through. Did Alpesh say his wife and son own Eli Lilly? Yes. Would you rate dollar average into ETFs a decent strategy of staying up for a newborn? It depends on your risk appetite. Yes, it depends on the ETF, and it depends on your risk appetite. If you've got a very low risk appetite, which you shouldn't really have for a newborn, all things being equal, I can't give you individual advice. You probably, look, I'm going to tell you what I'd do if it was my newborn son, because it's what I did do, okay, and it's 7 years ago. But I can take that risk appetite. So this is not advice for you, and it's not suited to you. He got triple leverage S&P 500 index tracker. Simple, okay? Because I'm his daddy. So it made sense. And yeah, you know, because he's young and he can take the volatility. In fact, he's young and he didn't even know what the hell's going on. Let me see if I can pull that up. Okay, and then we got out of that in 2022 for the daddy bear, and then back in until earlier this year, until we got the daddy bear again. Okay, it was as simple as that. I mean, he had other things as well, like Amazon and all the rest of it. But when he was born in 2018, that's what we did. In 2018, he was born in February 2018. I could open the ISA. I don't think I opened the ISA immediately. The XXX was at 40, the S&P, the one I'm talking to you about. Now, whilst we got out of it during 2022, even if we hadn't and did nothing, it's now at 156. Even if we did nothing from the day he was born in February 2022 to today, that's gone from 40 to 160, let's say. Okay, so, and that was just that. In fact, in hindsight, all I should have done is that and nothing else. And he did a bit better than that, because obviously when it fell in 2022, we got out and then got back in at a lower price, slightly lower price. And then this year we got out and he's now back in, not to the triple, but the double leverage. But anyway, just assume we didn't and we took the big hits on the way down. But he could do that because I'm his dad and he didn't know any different anyway. Okay, so that's what happens. I should say. Now I've got more chats. Okay, Brendan, Alpesh, I used the method. I used your method analyzing yesterday and identify app loving I'm Alibaba, but I didn't buy any as I'm waiting for the webinar. They all jumped up today. Any thoughts on any of these? Well, you shouldn't really judge it on a day. I'd love to take credit for it because a day is what is noise. I think in the past, FEIM, I can't remember, but Alibaba is more volatile, and so is AppLovin. So I'd be careful with both of those. But if you elongate your time frame, I think you should be fine. I'd have to have a look because they're not the type I'd say, oh yeah, 5 years from now. I'd need to have a detailed look at Rahim. I don't want to just dive in and say, yeah, it'll be fine. Okay, so that's what you do. By the way, if any of you do want to, and I see some of you have gone in, if that doesn't work, there is a backup site, because sometimes if everybody goes on at the same time, then that's the problem we get on there, and it gets a bit overcrowded. Now, other questions, you can go there. Everybody on the webinar gets a 40% discount because it's the webinar discount, and you get me for life as well. Okay. And I really think we need to get rid of these wealth managers who underperform. Do you calculate the Croaky, or is this supplied to you by Goldman? No, Goldman don't supply it. The Croaky formula is publicly available, but I have to calculate it from the data. Do you see what I mean? So it's not a proprietary, it's not a secret formula, if you see what I mean. So yeah, if there is, on CNBC, they were saying there have never been two 20% crashes in the same year. Therefore, is there any chance of a market going up? It's already crashed in April. Rahim, I'll give you an example. The third year after two positive years tends to be positive. So yeah, I mean, you know, all of those things point to the upside. I'm just trying to pick things a bit cheaper if I can. The biggest problem I've got at the moment is the market's already highly valued, which isn't really a problem. Thank you, David. Does XXX not eroding your capital investment? If it goes sideways, yes, it does, Stas. Exactly correct. But if you're going to hold for just one or two, so don't do triple leverage, basically, because it's not, you know, it's not suited if you don't fully understand time frames, holding periods, and so on. Okay, so don't do it, and you shouldn't do it in your pension. I can do it because it's for my son. I've got 2 private jets in the back room. Okay, I haven't, obviously, but you get my point. What I'm saying, just because I can do it doesn't mean you should do it. In fact, you definitely, I'm going to make this official, you definitely should not be doing leverage in your pension. All right, I can do it, you shouldn't. All right, but yes, it does erode if it goes sideways. That's correct. Absolutely correct. There you go. What's that? 2 years of 0% returns. Here, let me show you some more. What's that? 5 years of 0% returns. Absolutely correct. Do you now see why you shouldn't be doing it? Okay. Anyway, since my son was born, February 2018. Oops. Let's assume we didn't get out in 2022. Then he's there somewhere. Okay. Lucky boy. Lucky for the world. Oops. Okay. But you shouldn't be doing it. Don't do leverage because you will blow up. All right. Now, what have we got? Thank you for the webinar. Sorry, Alpesh, in relation to above, should I use PEG as a metric alongside higher PE ratios? Why are you looking at higher PE ratios? You want lower PE ratios. PEG is good as a substitute. If you don't want to use PE, just use PEG under 1. We'll keep it pretty strict. But can you see, if you've got an under 1 requirement or a Sortino above 1 requirement, can you see how you need more stocks? Because you'll have so many you'll have rejected. It's like getting CVs for a job application. You know, these are all shit because we want them from, you know, PhDs. Alpesh, are you in good? Oh, I think I said that. Son and wife is. That's all good. Okay, guys, I'm going to thank you for everyone who's joined the program as well. Any questions you have, let me know. Oh, John. Hi, Alpesh. In the scenario where you were in the quality 5 plus but are now out, and it's become clear that it's V-shaped recovery and feels too late to get back into those and not on GIP, what would your I can't give you advice. What I can say to you is my wife and son are in, so that's half the family is in, and I'm just going to wait to pick some things up cheaper. It's the other half. You can do 50-50. I don't know why private investors think it has to be all or nothing. You could always edge in 10%, 10%, 10% each month. You could dollar cost average in. I don't know. Private investors seem to want to pick bottoms and go all in. they're like the GB news of investing. It's all black and white and so simple in life. Okay. Or the socialist worker of investing, one extreme to the other. Hi, Alpesh. Where could you review Navy, European Defence ETF? Please could you? Sorry, Chetan, I'm bloody blind, aren't I? Let me do that offline and come back to it. I'll make a note that there's been a request for that one. The issue is, I know what you're thinking. Oh, it's European defence. You can just simply use the daddy bear rule to stay in or out. I'll do a thing and I'll explain it. But you're against DCA. What's changed? Nothing's changed. I'm saying you could do it if you wished. I like to add to winners personally, and I like to. Dollar cost averaging is a good thing for retail clients who don't know any better and what to do. Okay, that. It's not an obvious solution. I prefer doing what hedge fund managers do, which is adding to winners. So adding to winning positions once I've got profits. That's all. What I'm saying to you guys is, it's like me saying to you guys, you know what you should all do? Same thing Warren Buffett said to everybody, retail clients, get an index tracker. And that's it. Okay. But Alpesh, thought you were into liking stocks. Yeah, I'm doing that. Doesn't mean you should. You might want an easier answer or an easier life. An easier life is an index tracker. Okay, for you. Thank you, everyone who's been on. Love it. And let me see if there's anything else I've got to show you. Whoops. Yeah, do go. Oh, by the way, yes, a ton of stuff I've got to give you. I've got to put the files up. I'm also going to show you a brand new website with a whole load of free resources. Okay, I'm going to show you a bunch of free resources, which are on the campaignforamillion.com website. Okay, on that website, and the free resources are all here. There you go. There's a whole ton of free stuff there, which I think you will hopefully like, including books, amongst other things as well. Okay. Thank you all very much. Thanks everyone for being on here. I think if whilst I'm going to sign off, I think if you stay on, I'll still be able to get your emails, and I can do those offline later or reply to them through TikTok or YouTube. By the way, don't forget, I have got a YouTube channel and free investing newsletter. Oh, I should put that up a bit, shouldn't I? There you go. And I highly recommend it. I'm also on LinkedIn, as you might know. Okay, so I don't know if you've seen my LinkedIn. So I'll just show you that as well. LinkedIn. So there you go. You can follow me on there. That's me. Men for gender balance. That's interesting. And I've got interesting articles on there which you might like. 10 reasons SIPs are better than St. James's Place for managing your own pension, and I've gone through a whole table. A friend of mine's the chief economist there. It's a bit awkward. But what can you do? And yeah, so I've got a whole bunch of stuff. Oh, such a cheesy photo. I didn't post that. I mean, my team posted it for me, and they went and chose that photo, and I'm going to have to tell. I've told them now, don't ever use that one. That was done as a laugh. So we had a photo shoot, and I did that one, and the photographer took it and uploaded it, and now I've got my team thinking it's funny having it. So anyway, there's lots of articles on there as well that you might like as well. That's my wife. There you go. Okay, peeps. I'm going to leave it at that. Alpesh. Oh, the pension calculator. Yes. 1 second. Let me do that. Add new file. File name. Pension. Remember, it's rough and ready, though pretty. I mean, your own personal circumstances might be different, but it works on if you start off with 500,000. Pension retirement projections. There it is. Pension retirement projections. Give me 1 second. I'm going to put it up. I'll tell you when I've done it. pension retirement projection share. You should be able to see it now. Should have come up in the files that I'm sharing. Any issues, let me know, and Glyn will just email it to you, but should come up on there. Okay. I don't know where on your side the files show up, but wherever they show up, the pension calculator's there, and it shows you the sort of ages, and it's built on if you had 500,000 at that start age and what your retirement age is and what the growth would be, and it just shows you actually how worrying it is that you need higher growth, and that's the biggest problem. And our fund management industry is destroying that growth because it insists on tracking the UK markets because they're in the UK, whereas the US people are just making shed loads more money. Okay, so that's where we are. That's not me. It looks like an uglier version of me, I know, but oh, Simon, my mate. All right, so that's where we're going to go. Oh, I've been given that top voice status by LinkedIn, which is very, very nice of them. So 25,000 followers there. Do follow me on TikTok and LinkedIn as well. They gave me this. Did YouTube. So there's a lot of free education there as well. Okay. Right, I'm going to go now because it's 10:30 and I was up at 5:30 today to go to the gym for 6. I'm not normally that guy, I should say. Thank you all very much, and wishing you a peaceful evening. Thank you all.